Tangible assets are usually asked as part of another question. In this case, it's been combined with VAT. Before we look at all the information that's been provided, it's important to go and see what's required. We need to draw up the VAT control account. Keep in mind that VAT control is simply SARS VAT. It could be called SARS VAT instead. Different businesses will use different names. But this is a liability account, which means it'll get smaller on the debit side and bigger on the credit side, showing how much you owe to SARS. We then need to calculate the loss on the vehicle sold. When calculating a profit or loss on vehicles sold, the easiest way to do it is to draw up an asset disposal account. It is possible that there's another way of doing it. If, for example, they gave us the carrying value and the selling price, you can then just look up the difference. But if they give you the cost and the accumulated depreciation, the easiest is to use a T account for it. Why do you think the vehicle was sold in spite of a loss made? Now that's interesting because it means immediately we know that the asset that got sold resulted in a loss, which means in asset disposal, you would have a loss on the credit side. We will not need to also keep in mind any other information that's provided that would explain why we might have sold it in spite of a loss. At this stage, you could think of any reasons, things like maybe it's just not needed anymore, maybe it's getting expensive to maintain, etc. And you can just make little notes in the margin that you can use later on as you get information and see if they are valid or not. We then need to complete the tangible assets note to the financial statements. Whenever you're doing a tangible assets note, it's always useful to do T accounts for your assets. Now, in this case, you can see that the equipment figures have all been included. So we can just do for vehicles on the side. We can abbreviate as much as we like in our T accounts because they're just for us to see what's going on. We then need to consider the depreciation policy that was applied to vehicles. Do you think the depreciation policy is suitable? Explain your answer, quoting figures where relevant. So we need to keep an eye out for anything that tells us, is our depreciation policy correct or not? Now, deciding whether a policy is correct or not is looking at, is it accurate? Because remember that we want our financial statements to be as realistic as possible. Possibly when we look at something being sold, we can see if it was sold at market value, how does this relate to the carrying value? It should ideally be very similar. And if not, that's often a clue that the depreciation policy is not correct. If the owner decided to change the depreciation policy, what implications would this have for the accountant and why? Quote the relevant IFRS principle in support of your answer. Any time that you need to change any policy, it's very important to keep in mind that IFRS says that we need to be able to compare. The comparability requires that we show the figures for last year, at least. You can also show more, but you want your figures to be comparable to last year and the year before, which means that you need to be consistent in your application of policies. Now, in this case, obviously, if you want to change the policy, that means it's not going to be consistent. And what happens then? If you have to change anything, you would then need to go back and restate the figures for the previous year. as if you had used the alternative policy, and then what would the figures have been then. So it's pretty onerous. It's very important to try and get it right in the first place. So let's now go back and have a look at the information, and we can see we are told Botha Traders is VAT registered. And the VAT control had a credit balance of 13,500 at the beginning of May. So that means immediately we can show the credit balance over here as 2024, May the 1st, balance brought down, and the amount of 13,500. We're then told that the VAT return was submitted and payment made on the 3rd of May. That simply means that the amount that was the balance is the amount that we're going to pay. So we can show it on the debit side. Obviously, if we paid it, the other account involved would be bank, and it would have had to go through the cash payments journal. And you'll simply use this 3,500 that we already had as the balance. That becomes the amount that is going to be paid. During May and June, output VAT of 20,000 was charged on sales, and input VAT of 13,000 was paid on trading stock and operating expenses. The amount that was charged on sales, the sales would be goods going out of the business, and therefore it's output VAT, and therefore on the credit side. So we would show it's for May and June. So we would need to show June the 30th. Remember that VAT returns are usually done for 2-month periods. And the easiest is just to call it output VAT. In reality, you might bypass an output VAT account, and you could then have your details as bank or debtors. That would also be absolutely fine. And the amount over here is 20,000. Now, because I've got lots of other things going on, I'm putting it in working brackets because then I can add in the other bits and pieces also. On the other side, also on the 30th of June, I'll show the input VAT with a beginning calculation amount of 13,000. The statement of financial position on the 30th of June included the following. In non-current assets, we can see that we've been given tangible assets. Now, tangible assets is over here in the note. The fact that I've been shown my actual statement of financial position means those figures would have come directly out of this note, because the note is where you would show all the calculations of how you got the figures on the face of the statement of financial position. Now, obviously, those amounts are the totals, and it would be the total carrying value. So the beginning of the year would be the 492,000, and the end of the year is 568,833. And then hopefully you can see that you can very easily simply work backwards to actually get the carrying values for vehicles at the beginning and end. Although you could do it now, I normally like to leave all my adding and calculations to the end. I first want to use all the information so that if I pick something up along the way that would change it, I don't need to recalculate. Financial assets I don't actually need for this question. It's simply been entered there just to check, do you understand the difference between financial and tangible assets? And then we're told about the vehicles. The business's only vehicle was sold. Only tells us that there was only one, and so whatever the balance was at the beginning, it got sold, and then in this case probably we would have bought a new one, because otherwise you'll be without a vehicle. So it was sold at the beginning of May 2024, in other words 2 months ago. And if it was 2 months ago and we're looking at the year end, that means we owned it for 10 months. I would immediately go to my vehicles account. Now, I don't yet know what my balances are, but I know that everything got sold. So I could actually close it off because whatever was the balance at the beginning is the amount that's sold. And on the credit side, next to where I'm going to show my disposal, I would actually put 10 over 12 so that I know when I've got to calculate my depreciation, I need to do it for 10 months. Now we can see all the information. We've obviously got the details of what it is. It's in the vehicles account. The date purchased was a number of years ago, about 4 years ago. And there's the cost price. This is the figure that we need to be able to put it into my T account. So immediately we can see that the balance must have been 600,000 and 600,000 would have been sold. So you can immediately put that in as the cost at the beginning of your vehicles account, and you can go to disposals and show that the cost would have been 6,000 minus whatever your disposal would have been, your accumulated depreciation. We're then also given the rate of depreciation is 10% per annum on the cost price. I always like to go and put that at the top of my vehicles account, 10% CP for cost price, because again, when I want to calculate my depreciation, it's going to be much easier because I've got all the information I need. Over here, it tells me that the maintenance plan is 4 years or 100,000 kilometers. Now just think, remember that we said this was about 4 years ago. So that means that my maintenance plan is coming to an end. It's about to expire. Now that is a very good reason why we might have decided to sell the vehicle. So over here, where it asks, why do you think the vehicle was sold in spite of the loss made? The most obvious thing to say is that the maintenance plan is about to expire. Which means that it would become much more costly to run. You could also add in things like it's not needed anymore, or a new vehicle suits the needs better, etc. Remember that this is for 3 marks, so you need to have at least 3 valid independent points, or explain in detail. You need to have 3 good ideas for that. The details of the depreciation, you can see that you're shown the depreciation over the entire period. Now, obviously, we are mostly concerned with the depreciation at the end. In other words, this 50,000, which has nicely been calculated for me to show that, there would have been at the beginning of the year, the balance in accumulated depreciation would have been 180,000, which is this balance over here. And then I would need to record 50,000 for the current depreciation. So that's going to be the depreciation on the new vehicle, on the old vehicle. And then you would have needed to take all of that out to asset disposal. So if we're calculating the profit or the loss made, you can see in asset disposal, we would need to show the 600,000 that was the cost. We would need to show the 230,000 that was the ACDEP. And then you can see that once we know how much was actually received for it, we'd be able to go and work out the loss. Over here, you can see the 245,000 is the amount that was actually received. So if we put 245,000 in, you can see that the carrying value was 370,000. Looking at the cost minus the ACDEP, that's the 600,000 minus the 230. and you can compare it to the 245,000 that was received, there's quite a lot missing. They actually made a huge loss of 125,000, which is rather extreme. Notice over here that the information tells us that trade-in prices of 230 and 240 were also offered on the vehicle. So if we then compare that to the actual selling price, you can see that it's in line. They got the best price they possibly could. They certainly weren't selling at a loss just because they were trying to sell it fast. They actually got a pretty decent price. So that immediately tells me that there's something fishy with the depreciation policy because it's not being depreciated enough. And you can see that because the carrying value was much higher than the market value. This means that the rate that they were using is far too low, and they should actually then obviously change it. On the other hand, it could be that they've just got one vehicle that they were using a lot. And if they were using it a lot, they need to then add more depreciation to the policy that they're doing. So they would need to depreciate any other vehicles they got at a higher rate. Again, 3 marks means you need to have at least 3 valid points, but at least that will give you an idea of where to go. A new delivery vehicle was bought to replace the old delivery vehicle on the 31st of May. So that means that you've got a new vehicle coming in on the debit side of your vehicle's account. If it was bought on the 31st of May, that means you've only had it for 1 month. So you can show 1/12 on the debit side of vehicles. We can see here 575,000 was paid on this date, and the new vehicle is to be depreciated at the same rate as the old one. Now notice, if that tells us that the 575 was paid, remember that the amount paid is inclusive. In other words, for the purposes of my tangible assets, in other words, in my vehicles account, I would need to calculate what is the original exclusive amount. And you would do that by simply saying the 575 times 100 for the exclusive is what I want, over the 115, which is the inclusive amount that I've already got. Remember the VAT triangle that you can use? VAT is 15%, exclusive is your 100, inclusive is therefore 115. And you're using those figures over there, what you want over what you've got. That means that my new vehicle is 500,000, which I can show as additions at cost over here in my tangible assets note. At the same time, let's quickly go and update the VAT control account, because we can now see that the 575, if that was inclusive and we are VAT registered, the 75,000 can be claimed back. It's a vehicle that's coming into the business, and so it would be included as input VAT. At the same time, if the one that we sold was excluding VAT, we would need to take the 245,000 and add on the VAT to that to get the inclusive amount, or calculate it as 15% of the 245. And I'll just show you the calculation over here. So obviously 245 times 15 over 100, which will give you 36,750 that needs to be included in the output VAT. We're told that the new vehicle is to be depreciated at the same rate as the old one. Not ideal, as we've already figured out. Maybe we need to use a better depreciation rate, but that's what we are told to do for now. So that means that we're going to go and calculate the depreciation as the cost of 500,000 times 1/12 times 10%. I can show it to you over here. Your 500,000 would be your cost times the 10%, which we know about, times the 1/12, because we only had it for 1 month. And that would then give you the 4,167 depreciation on the new item. Once you've done that, you can go back and check, have we actually done everything we need to? Well, the VAT control account can be calculated and balanced, and you should be able to see that the total input VAT will be 88,000. The total output VAT is 56750. That means that the total is actually bigger on the debit side. So you put the debit total of 101,500 in, and then you fill in a gap with the missing amount of 31250, and that will be your balance carry down, which will be on July the 1st, the balance brought down. That means that SARS owes us. It's due to the business. In other words, it's a refund that we can expect. We've calculated the loss already, so that's great. We've explained why we think the vehicle was sold. We now need to complete the tangible assets note. You can see it quite nice and easily over here. If we have a look at the vehicle's T account, we've already put our 600,000 in. We've put our 500,000 in, so that's fine. Obviously, the balance at the end is simply the 500,000, so we can show that as the cost at the end. The accumulated depreciation on vehicles, we can take out the 230,000 because we forgot to do that. And you can see it now as soon as you check it from the T account. Yes, that piece is missing. We have already shown the 50,000 as depreciation, and we've put the 4,167 in as depreciation. For the depreciation, you're going to now add them both together to get your 54,167. And obviously the disposals at carrying value we already worked out previously as your 370,000. Make sure that you show your disposals and depreciation in brackets. If you don't put the brackets, you're likely to lose marks. It's very, very important that you show that you are wanting to subtract those figures. The final thing to do is now say, what is the final balance in the accumulated depreciation account? And you can see that the only amount that is there is the 4,167. And so you can show that as your end depreciation. And therefore the carrying value at the end is 495,833. And you can work out the depreciation at the beginning again. We can show that the 180,000 was the beginning amount from the asset accumulated depreciation account. And therefore the carrying value at the beginning was the 420,000. You can check yourself by working backwards from the total figures given also. And then you can just tidy up your answers for questions 5.1 and 5.2, and you're done.